think it was, I thought it was review, but I'm not sure.
Okay.
Good to see you, Kanan.
What up? Man, I'm driving from Seattle, so I might be logging in and off.
Okay, no worries.
Training or whatever, so I might turn the video on and off a little bit.
Okay, no worries. You ain't the only one in your car. We got one or two others.
Hey, Nat, it's Ted. Can you hear me?
Yes, we can hear you.
Thank you.
Yep, absolutely. I see that we continue to get a couple more trickling in. I will kick us off here, and I'll just give us one more minute just to see so that we don't miss any introductions.
You're going to have to keep me on track because I can't get the notes to show on here.
Okay.
Cool.
I'm passing it off to Don.
All right.
All right, I'll go ahead and kick us off because I think we'll still see a couple start trickling in, but I just want to make sure we can get through it. And again, as always, want to thank everybody for tuning in to our NAMC University training on getting paid, liens and bonds, which is very essential, as we all know on this call. And for everybody who will see this recorded copy, that is kind of the precursor to you getting on public related projects, even probably private related projects, and showing that you're able to take on the risks of completing scopes of work as you build capacity on construction projects. And so I want to first start off by thanking our very own Don Shanklin on our board at NAMC with Propel Insurance. And then Don, if you want to go ahead and introduce Kyle Smith, who's also a great contributor today as well.
Yeah, I also have one called Cal Smith. He's the Northwest Region surety agent for Zurich Insurance. Cal has been in the surety industry for a long time and has a ton of experience, and he helps me out on some of the accounts that I write and that we write together. And
then I want to definitely thank all of our NAMC University committee folks like Kiewit's team. I want to thank Kent and Jim for continuing to stay tied to this organization and certainly the work of NAMC University. It means a lot, and I will want to make sure you know that members are taking notice because they ask a lot about Kiewit and, you know, certainly some projects you guys have coming down the pike that they want to certainly see themselves working with you guys on. So let's keep that commitment. Same as Anderson and same with Ted Odlin, and you know the list goes on. I just want to thank you all personally for continuing to engage. I think Kanan brought that into the space last meeting. And just to kick us off, for all of the active BIPOC contractors in the meeting, you know, please just flag your information. We are checking the chat line to see who's in the room so that we can frame today's discussion around your business case and your needs and the services that bonding can afford to you as you scale your business. Also want to thank our A&E firms and Clarence Thompson also tuning in, and so you want to see how that this effort fits into his vantage point as an engineer, and certainly others. So please share your information on the chat. We're going to record this, and as people trickle in, I'll ask that both James and maybe John and Ebony ask people to flag that so we don't have to interrupt the discussion. And as always, you know, Edwards and others, like if you got questions, comments, or you got it figured out, great, but please do bring your own ethnic voice and authentic voice into it. Even if you know this, maybe there's something that somebody else might gain and learn from each other. So without further ado, I want to hand it over to you, Don, to kick us off.
Good afternoon, everyone. Thank you for attending this bond training presentation with insurance. I just want everybody to know that I'd like for this to be as interactive as possible. It's a lot of information that we're going to share, and we're touching on, we're touching on bonding and insurance, but we would like for it to be interactive and ask your questions as you have them. Because I'm sure if you have a question, someone else on the call will have the same question, but maybe too shy to ask. So we invite any and all questions to the group. That being said, I'm just going to dive right in. This is our agenda today. The principles of suretyship, surety versus insurance, the 3 C's of surety, basic understanding of financial statements, what internal systems are you using, kind of a underwriter's review, and things to consider when selecting a bonded agent. So first off, surety bond. The definition of a surety bond is a 3-party agreement whereby the surety assures an obligee that the principal will complete an underlying obligation. I look at this as a security blanket for the owner of a property, someone who has, I don't know what the financial obligation is, but they have a project that they want built. Not only do they want it built, they want a guarantee that their project is going to be completed per the contract. Surety versus insurance. I put this slide on here because it really illustrates a little bit of the difference between surety and insurance. On the left side, we have the Tower of Pisa. If you were a construction contractor and, hopefully these weren't the plans, but in the event, of a surety, you have a tower that's been constructed, and as all can see, the tower is leaning one way or another, whether it's by design or by mistake. The surety would have to come in this instance and review the plans to see if this tower is supposed to be leaning or not. On the right side, we have a car hitting another car. This is the insurance side. And we'll go into the definitions a little bit more right now. So how surety is different from insurance. A surety is a 3-party agreement. It's also fee-based premium. The premium is based on the size of the contract times the rate for the bond that particular contractor may have. It's also non-payment does not affect the liability. Maybe I'll do these congruent because I'm gonna start over at the 3rd-party agreement. Surety is a 3-party agreement. Insurance is a 2-party agreement. You have the insurance company and the client or the business owner. Sureties are fee-based premiums where insurance is actuarially based premiums. A non-payment of a surety bond does not affect coverage the way that non-payment results in cancellation on the insurance product. Sureties assumes no losses, where on the insurance side, losses are expected. That's the way it's underwritten. Sureties are non-cancelable. Once a surety is in place, it's in place for the duration of that project. To where insurance policies are cancelable, can be canceled for various reasons. In the surety contract, it must be in writing. On the insurance side, it may or may not be in writing. We all purchase insurance on our car. We go and buy that new car. The banks, the lending institutions are making sure that, you have insurance on the new vehicle in case an accident happens. They are trying to protect their asset. On the surety side, it's the same way for an owner. The owner is trying to protect the asset that he's hired a construction company to build. The surety is a 3-party relationship. You have the surety, you have the bond. You have the surety, the principal, and the obligee. And then you have the underlying base contract for that surety. And these are the definitions of the principles of suretyship. The surety provides credit in the form of a bond. The surety is indemnified by the principal against loss. The obligee, owner or upstream contractor has assurance that their obligation will be met and gets a pre-qualification that the principal can complete the job. I like to think of the obligee as, it's the construction owner, but they've already gone to the bank No, I'm sorry. The obligee, the owner, upstream contractor. So yeah, they've already been pre-qualified by a surety company, has given them all of their financials to say, yes, we can or cannot grant or complete this job. The principal is granted credit and is responsible for fulfilling their obligations to both the obligee and the surety. So in this case, we have the surety, the obligee is the owner, and the principal is the general contractor in this instance. Let's go by, look at the types of construction bonds. Oftentimes, I know in bid documents, they will ask for a bid bond. Bid bonds provide financial assurance that the bid has been submitted in good faith and that the contractor intends to enter into the contract at the price bid and approve and provide the required performance and payment bonds. The bid bond is essentially like if someone wanted to go buy a car, you don't know what kind of car you're going to buy, but you also want to go and make sure you get pre-qualified so that when you're going and negotiating with the car lots, you already know what amount the bank has pre-approved you for. The bid bonds work in similar form in being that the surety company has already reviewed the financial statements. Once you submit that bid bond to the surety, they're going to look at your file and says, okay, this bid's $1 million. The contractor may be good for $2 million. So yeah, sure, good. We will give you a bid bond or provide a bid bond. And if you are the low bidder, we will also give you the payment and performance bond. The performance and payment bond usually combines into one form which guarantees the contractor will complete the job in accordance with their contract and that they will pay their subcontractors, laborers, and or suppliers in event of a loss. Surety bonds, I mean, there's always a potential that you're going to have a contractor that maybe run into funding issues or something happens on other jobs to where they're not able to fund the rest of the project that they're working on under a bond. In these cases, the surety has the option to remedy the situation. And it's usually done by one of three things: in either a pay the penal sum of the contract. They can fund the contractor if there was a financial situation and the surety still had confidence in that contractor to finish the job. They just needed a little bit of funding. Or the surety can decide to hire another contractor to complete the job. And all of these scenarios, in case of a default, the general contractor who posted the payment and performance bond is on the hook to fully indemnify the surety company, meaning whatever amount, whether it's a penal sum payment that they made, or if they gave funds to the contractor to fund the contractor through that project, or if they hire another contractor, whatever amount the surety is out to get that job complete, you've been indemnified to say the surety company needs to be reimbursed whatever amount that they have put out in this default case. An indemnity agreement. This is an area that, you know, it's one of the most important areas. And if you have bonding, if you're on this call and you have bonding, I really want you to understand the indemnity agreement, because this is where, you know, oftentimes they say you have to put your house, your kids, your home, everything on the line just to try to provide the bond. But when you are looking at the indemnity agreement and the surety, the indemnity is a form of, if we pay out, you got to pay us back. Remember, in insurance, if the insurance company pays out on an auto claim, there's nothing to be repaid back because that has been captured in the premiums that you're paying monthly for the insurance policy. In a surety bond, you pay one fee up front, and that's all you pay for that bond unless there is a claim. An agreement between the surety and the contractor that outlines contractor's financial responsibility to the surety in event of a loss. Contractor signs personally and corporately. Owners and spouses with greater than 10% ownership typically will have to sign. And it comes up all the time. You hear, you know, you have a contractor asking, well, does his wife have to sign the indemnity agreement? Or does, someone that's 11% owner have to sign the indemnity agreement? And the answer to that is yes. And it goes back to way before my time. Spouses were not always required to sign an indemnity agreement. But what would happen is once a contractor got into a bind and it was looking.
Whoa. You're good.
Headphones went out. Sorry, y'all.
Yeah, and once it looked like there was going to be a claim, a contractor would transfer all of his ownership to his wife. So when that claim came in, surety paid the claim, got the project finished, and then come back to the owner for reimbursement. The owner didn't have any ownership in the company, and it had all been transferred to someone that's not on the indemnity agreement. So I don't know what year it came into play. Cal, you may know of when all spouses and their owners greater than 10% were starting to be required to sign the indemnity agreement. Do you know the answer to that, Cal?
No, I don't know exactly when that came into play, but yeah, it's with common law ownership. What's yours is mine, mine is yours. Plays into that. And yeah, it's typically about 10% or greater would have to sign the indemnity agreement. But yeah, I'm not sure exactly when that practice started, but it's well before my time.
Okay. So signing of the agreement must repay the surety for any paid losses the surety makes on behalf of the contractor. And what's looked at is the financial assets are looked at of owners. The surety company wants to make sure that any amount that they've paid to finish a job or to fund a contractor, they want to make sure that all those parties that are indemnified have some kind of hard asset in case there's a claim situation from the surety. The 3 C's of suretyship, I'm going to let Cal run with this one because it plays a vital role in the underwriting of a surety company. These 3 C's you'll hear not only from me, but from most surety agents. Cal?
Okay, thanks, Don. Yeah, the 3 C's of surety. Character, capacity, and capital are the 3. First off, let's dive into character. And, that's the moral and ethical nature of an individual or business entity. Honestly, it's all about, what kind of person you are. Are you going to hide stuff or not be upfront about, maybe bad information has, maybe there's a loss looming or a big write-off on a big job that's going to have a financial impact. And you don't tell the surety about it, but yet you're looking for more additional surety credit, more bonds. And so, that's plays into a character profile. And so it's, looking at, are you paying your subs on time? Are you constantly getting into lawsuits or, liens against you, or are you leading people, or are you getting along with basically others in the marketplace? And if you're a known troublemaker, it's one of those things where, it plays into the underwriting role, is your sense of commitment to the partnership. That's what surety is. It's not transactional. It's very much a relationship-based relationship that, partnership between the two that, you're looking to build up a rapport and longevity together. And, that's going to play very favorable into both parties, to maybe stretching on some larger projects or backlogs that maybe your balance sheet doesn't support. But, we've been down that road together for a long time. And so, and when you know each other, we know each other well, and what you're capable of and who you are, it tends to play well for extending surety credit. And capacity, which is the second C of the 3 C's of surety, that's just the contractor's ability to perform a project. We look at capacity used in a few different examples. It's like, what's your prior experience in performance record? Do you have a trend, a track record of performing certain size jobs well, certain scopes? What's the organization and management? Do you have the manpower? Or is it to manage a larger program, like multiple projects at once? Do you have the systems in place to be able to track those jobs accurately? Do you have the equipment base to pursue programs that maybe you're pushing to take on an additional job, but you already have 2 others underway? And do you have the equipment and manpower to be able to place on that job to perform successfully in a timely fashion that the contract dictates?
1 second, Cal. Can everyone mute their microphones, please?
All right. So yeah, that's that would be capacity. So we'll move on to the next one, which is capital. Oftentimes there's a 4th C that is kind of thrown in the mix, and that falls under the capital aspect, which is cash. That's one of the things that will always be looked favorably upon you when you're looking for surety credit. And so this measures the contractor's financial ability to assume the risks of the business activity. Looking at your working capital, your equity base, the cash flow of the operation. Do you have adequate bank line that supports the program that you're currently running or looking to pursue? So yeah, that would be very capital is the financial metrics.
So Kyle and Don, real quick, I've got a question because we had a great informative meeting last week with kind of our open house with some of our BIPOC contractors, and capital and capacity came up early and often. And certainly there's still the dilemma of those who have relationships to be able to tap into capital easier. And then those who are still kind of, whether they got good credit or not, are just not seeing because maybe of some bias or discrimination, not able to access capital. And I think on the equipment side of either owning versus renting, I guess the question is how do you tie and package those things together for small businesses who kind of still see themselves as not getting equal access to be able to get bondable or even grow their bonding? So just more or less general question, but just wanting to know how we take advantage of some of those areas that we know to be true, but then what do we do to set businesses up to really start, getting to a point where they can access more capital, and just wanting to know if there's any lessons learned.
Nate, I think that's a real hard question to answer. Not hard in the sense of the question itself, but we've all known that financial institutions have discriminated against BIPOC companies for years. And, there's articles out, especially right now, that speaks to the loss of revenue to financial institutions for not lending to BIPOC companies, right? So when we're looking at working capital and equity, cash flow, the capitalization of a company of which the sureties are primarily making their decisions on, it has to be something. First and foremost, the contractor has to find an agent that they're comfortable sharing all of their financial resources, because in order to build capacity, it's not something that happens overnight. And it's going to be a sequence of, if you look at what I've done for contractors from start to finish, sometimes that process has taken 5 years to get them to a place where they have enough surety credits to operate for whatever trade they're performing. It's a long road, but if you follow a plan, if you're one that are wanting a plan to follow, we can create a plan. We can look at jobs and look at the profit margins to make sure that you're doing your part. Then we can help you obtain the rest in those situations. But I think the biggest takeaway here is that it takes time to build capacity, especially if you're starting from zero and you're trying to build that capacity. One of the first places that I take newer companies into the surety world is I take them to their credit, because that's going to get them instant surety without having to provide the 3 C's of surety, if you will, to an underwriter. It's not that you're not providing it, but it's just looked at different. But it's a really good place for a company to start that, you know, don't have the financial statements or don't have the backing of a financial institution. You know, what do they have? They have the credit. Sometimes that can be difficult to get cleared up, but that's the easiest place I would point to get, you know, 500 or $1 million in bonding, and you get it on a credit check, and it's fast, but it's work to get a company from 0 to 500, 500 to $1 million, $1 million to 1.5. It is work, and they do need bank line. And we all know that, you know, if you need a bank line, the banks don't want to give it to you. You know, if you don't need it, all the banks are coming at you at once offering bank lines. They're crucial. They're needed. It's a safety net for the contractor. In event you have a slow pay, they still have the ability to go somewhere to borrow that money to keep things going. And once the check comes in, they pay that bank line down. Working capital is another one where, you know, sometimes you have to count the pennies, and you have to be really observant of how your company spends money. You know, I was with a client the other day, and she says, "Yeah, Don, I was looking through the trash can, and I seen all these paper clips." Well, I'm looking at the paper clips in the trash. I told my system to get them out because I spent $600 last year on paper clips, and that $600 could go towards someone's paycheck, someone's benefit, a lot of different things. So you have to be diligent about being able to save money and keep money into your company and paying taxes. That's my answer for your question. It was a little long, I apologize, but that's a tricky area. Would you agree with what I just said, Cal? You muted.
Sorry, I had it muted. Yes, well said, Don. I definitely agree. Thank you.
Okay. Next slide.
All right, so the next slide is financial statements. And this gets into the 3 types of financial statements that are available by a CPA. Year-end financials. This is kind of the lifeblood in which an underwriter will look at the financial health of a contractor and review the notes and schedules that they will provide that you know, give a very full, engaged look. It's kind of like what each year, you know, that reviewed statement by CPA really brings things together and out, you know, kind of lays out where a contractor is at and where they're going. And the 3 types are, you have a compilation, which is oftentimes the cheapest of the 3. And, you know, typically if you're doing projects less than $1 million, a compilation will suffice. And this is a presentation of that the accountant is putting together that just assures conformity with the generally accepted accounting principles or GAAP.
Calvin, before you go to reviewed statement, I just want to identify when a compilation usually is used. Typically, I think you'll see that contractors that are doing a lot of small government contracts. When I say small, I say under 100,000. But there's a sequence of them that they're getting every year. Let's say they're doing, you know, 15 or 20 of these small contracts throughout the year. If they don't have any desire to go to the bigger projects over that, whatever, you know, they're used to, then most times the CPA isn't going to ask for a reviewed financial statement. The compilation is good because the financial risk and the data that they're looking for is fairly small. Would you agree with that, Cal?
Right, correct. Yeah, I do.
Okay.
The next you have is reviewed. So reviewed statements, that's when you're doing $1 million and greater size single projects. When you're looking at anything over $1 million, that's when a reviewed statement is required. And the CPA is going to provide a little bit more schedules. They're going to just provide more assurances that the numbers are more reliable. They'll do a test review on a project to make sure that it tracks and trends, and this is something that I mostly look at, and it provides a lot more detail. And then when you start getting to the level of 100 million and beyond, in revenues, that's when an audit is required. Back east, they're a little bit more stringent. It's just accepted that I think it's as low as 10 million they're asking for audits, and audits are considerably more expensive. And so that's when you're getting the full testing. That's when each project is being reviewed by the CPA to provide accurate accurate numbers, and it's a very comprehensive look at a financial statement.
And just let me throw in a little bit about the review's financial statement, because this is one it causes heart pain. I'm not going to even lie to you guys. It causes a lot of heart pain because, after a year has completed, oftentimes we are seeing the reviewed statements come in March, but from January to March, there's sometimes a lot of jobs that are put out on the market, and the surety company can get to where they're in a holding pattern until they see the reviewed statements, because they need to see and they need some assurances that the numbers that we've been providing throughout the year, maybe from a CPA or from a bookkeeper, they want to make sure that all of those numbers and profit margins and profitability on jobs, they want to dive in to make sure they are actual. So, I've seen some jobs get held up because, the owner maybe put the review out and kept pushing it off or not getting the information back to the CPA. And it resulted in some delays, and it also resulted into some anger. Nothing that I can do, nothing that Cal can do. It's the owner and the CPA. It's really important to try to get your financials done at the end of the year as soon as possible, especially if you're heavy in bonding.
Yeah, every year it's a little bit different. It's CPAs, the load that they have any given year can change, and maybe there's a new gap financial rule that they have to implement, and that might take additional time, or maybe there's a pandemic virus out there, and folks are working from home half the time, and they're not as productive as they once were in the office, or doing shifts. And so sometimes you'll get these statements that come out and they're timely, and then you're like, wow, this was a good year. But then some other times you're waiting for August until you're seeing a fiscal year end statement, from 8 months ago. And so, those times, that's where the partnership and the relationship comes into place. When for my contractors, I like to get out and meet with them, annually and develop this rapport and just get some verbal figures from them to understand where they're at, and that will tide me over until the year-end statement finally trickles in. Yeah, it changes. I wish it was more like clockwork, but it's at the mercy of the CPA.
I got a kind of real quick. I got kind of a comment or question. I want to actually put Ted Odlin or Jim on the spot a little here, but I'm curious from like a higher level kind of majority general contractor, hearing what Don and Kyle just said, to just kind of inform some of our members. Like, are there examples of these pitfalls where it can kind of sour a relationship quick if people don't have a lot of their stuff together when you're assessing them? Or, I guess when a GC, back to that relationship, because many are on this call trying to build relationships with our partners, like, what should they be thinking about when, their financial statements aren't as, accessible or maybe not in the kind of shape you want to see them, you know, related to the bonding? Are there, I guess, any nuggets of advice that you guys would offer that would bode well for the group?
I can answer. Cal, you can answer as well. I think that one of the things that keeps the fire burning not so hot is a lot of communications with your surety agent or with your agent who's representing the surety. As long as you are communicating and answering the questions, because oftentimes, you know, our in-house financial or CPA reviewed financial will get sent over to the surety, and the next email you get back from the surety is a list of questions about those, whatever they have questions.
This thing keeps cutting off on me.
There he is.
There you go.
Sorry, it just keeps cutting out for some reason, but you'll get a lot of questions. As long as the contractor is coming back and being forthright and as honest as they can be in the communications with the surety, we can head some of that off. I just think that, you know, oftentimes when contractors get in a pinch, they think that they are in this world alone and they don't want to bring anyone else into their problems, when if they bring us up in with them, we can help tackle that problem together and put some benchmarks in place to say, hey, we don't have your reviewed statement in yet, but we understand where you are. You've given us a copy of your 1231 statements. You've indicated to us that you don't expect there to be very many changes and or adjustments. You've told us that you'll have your, you know, your reviewed statements in, let's say, a month. And as long as you're committed to that, we'll give you this bond because the communication's been open. That helps out a lot, Nate. And I could just tell you, the more open you are with your agent and the surety, the better. Yeah.
Yeah, I mean, that's it comes back to the partnership. Like, we're all in it together. Like, you know, we want to write bonds. Like, we want to write bonds, and we want to, you know, have this close relationship so that you know, we can share in each other's successes. So that's and you know, hey, construction's risky. There's ups and downs, and you know, there's for every down, there's a good story about, you know, the rise back up to the top. So, you know, don't be afraid to, you know, to share that information, and you know, we can put our heads together and be flexible and figure out a good resolution or a game plan to move forward with.
And okay, yeah. Does that answer your question, Nate?
Yeah, I think Clarence posed a good question too. He said, what teaching resources are available for people who are just starting out? Like, are there places you can go to get information just to kind of get your feet wet if bonding ain't really where you're at yet? But like, is there any teaching or, you know, resources that might be offered? And certainly on the chat line, if there's any websites or any just additional information, please, you know, post it. But if not, then I guess that's just a general question to see if people can, you know, kind of start to engage where they might learn something.
I would say that a good place to start, Nate, is finding an agent that will work with you. Even though you're small, if you're showing the aptitude to want to learn surety and want to understand the financial statements, a plan can be put in place. And a good measuring stick for me typically is when I've had an in-depth conversation with a potential client or someone that's wanting to get into surety, and we go over some things. I show them what's important in their financial statements and what to look at. And then we come back to our next meeting and I have to repeat it all again as if I never said it before. That tells me, maybe this contractor isn't as serious, but someone that comes in like, okay, Don, now you told me how to get to my working capital. Now I need to understand how to get to my percentage cases and what the underwriters are looking at in my WIP statement. Those are the kind of learning things. As far as a resource, I can look for a place to go where there is some resources. I know that we've also included a couple of handout resources that I think NAMC sent out that gives some good resources as well. So there are some resources. If someone's new and they're wanting to get into bonding, let's get them hooked up with an agent, if it's me or someone else, that can teach them and show them the way to surety. And also, I just may want to mention, it's not a place that we like to go, but the SBA does have a program that allows a surety to extend more surety credits than what your financial statements will allow for, because they're guaranteeing it. But it's a tedious process, but sometimes that's also an avenue to start in surety. Back over to you, Kyle.
Right, next slide.
Underwriter Eyes.
So Underwriter Eyes, you want me to take this, right?
Yep.
All right, so there you go. Look at that. So what else matters? Let's look at some financial statements, internal systems, and case percentages. All right, so as far as the financial analysis, when I'm looking at, a statement, it could be a year-end or an internal statement, quarterly. What's important is, profitability. Profitability is huge, especially looking at a trend of profitability. Look at the trend of revenues, are there big spikes? What's driving those spikes? Or maybe you had a big year, then a down year. But, basically, if you're, annually, if you're a perennial, positive net income contractor, that's a very favorable attribute to have. Working capital, that's current assets minus current liability. The more, the better. And so, just having a positive working capital, is always going to play well. Equity base, that's just all of assets, total assets minus total liabilities. If you have equipment, that you own, that, or real estate, maybe where your office is at, and you own that property, and it has a positive equity base. Those are ways that drive equity. Quality of an accounts receivable. So yeah, you may show like a large AR, accounts receivable, on your balance sheet, but are they turning over? Are they all over 90, or are they current? Are they turning quick? And so you're getting your money back in the door to improve cash flow. And then another one of the schedules that I look at most is the WIP, the work in progress schedule. That's the one that shows all of your jobs on it that are currently in progress. Looking at a financial statement, like a balance sheet, income statement, that's a snapshot from, like we talked about earlier. If I got a CPA statement in August and it's a 12/31, that's 8 months old. But I can use that 8-month-old statement and look at the WIP, and I can see that, well, at that time you had, 5-6 jobs, and they're all trending well. They're all positive. They're making money, good gross profits. You have a lot more profit to earn that's left in that work. And so, that's a great statement to look at. Or maybe there's a late stage, 99% complete job, but there's, like a couple $100,000 underbilling. So, I'll ask a little bit more questions about that. Like, hey, what is this? This unapproved change order, or just unrecognized profit? What's the word? So that's a few more things I look at in the financial analysis.
And I'll also say, Nate, going back to the question you just asked about what a contractor can do if they're looking and wanting to increase capacity or get into bonding. If you take a picture of this page, and if a contractor can understand profitability, working capital equity, quality of accounts receivable, and work in progress, that gets them into a really good start. And it probably would leapfrog them into someone that doesn't know these things. Because these are all formulas, or have the potential to be formula based. And these are some of the things that I work with my clients and really wanting them to understand about the financial statements, because the financial statements has a lot of stuff in there, but it can be honed in to look at just a couple of areas. And these would be the areas to pay particular attention to.
All right.
And real quick with that, because I wanted to ask both Edward and maybe even David in particular, you guys deal with a lot of other small businesses in the community. And sometimes I feel like people don't take this bonding thing serious. I think with some of those firms that you guys work around, knowing that David and Edward, y'all take it serious, do you see that people don't really take some of this serious? Because I feel like this is the pitfall I hear a lot about with small businesses looking to advance.
I think that's what, this is Edward Donor Mainstream Landscape. I think for me, I've been through all this, so I understand it. I'm just here to learn and be part of what's going on. But I've been bonded over $6 million. That's my biggest bond. So for other people, it may seem, to me, my agent should be doing this for me. I should present what I have. I have an accountant. I present all this, and my agent does the rest. So it's really not that hard of a process if you have the right guy in place, like somebody like Don or probably Kyle. I haven't had the pleasure, but if he's anything like Don, then his experience is next level. And to me, this is not a difficult process. I think more the explanation of it makes it seem difficult to somebody that just doesn't understand. But for those of you who are watching and who have never done this, this is looks pretty normal to me, straight up. Looks like the process. And if you're trying to get into the money game, you got to do the process. That's the bottom line.
I'll speak on my behalf as far as the bonding and all that stuff. I haven't had the privilege of running into it a whole lot yet. Now that I'm approaching these bigger jobs, things are starting to change. Don Shanklin was pivotal in me transitioning over to an insurance company that I still use today. And it's been amazing. That's just the level where I was at. And now we're switching everything over to this one company where I feel like I'm graduating. And those are the type of questions that are happening, especially going through that Compass process with Anderson Construction and talking about bonding capacity and all that stuff. So it's up and coming. For me, I've done a lot of residential, as you guys know, and I'm getting into the commercial aspect of it now. And so that's kind of in the cuff of letting go of the smaller end and transitioning into the new. So yeah, I know it's really important. It's like, I know it's coming, and understanding this and having this be a part of this education is really important for me, because now it makes a lot more sense than it did a year ago. So this is very opportune for me right now.
Can I say one more thing? This is Edward again. What I will say is when you are doing your bids, definitely take this part of the bid into consideration, because I think something that Don and Kyle may have not said is this shit costs money, period. So if you're getting into the bonding process, it costs money to get bonded out. So you have to work into your bid. I don't know what Don personally charges or what his fees are, but I didn't realize that this stuff costed money to get bonded out. So that was something that I did not work into my bid and I lost, but that's how I pay for my certified degree from School of Hard Knocks.
Edward, can you explain to me when you say it costs money? Are you talking about the bond itself costs money, or the preparation?
Yeah, exactly. All that. Just the little fees that add up. If you want to play the money game, I call this the money game, getting bonded out, because you should be working on bigger contracts if you're getting bonded out, which means you're in the money game. But, what I see from these primes, and don't take it personal, the people of not color primes, is they want to pay you the least amount in the commercial industry, and then they want you to be the most insurance you have. So I'm losing money by having, all these bonds and the highest insurance and paying all this money into it, but they want me to do a wall for pretty much next to nothing. So that's just my experience. And so I've learned that. And I'm winning in that area, but I had to lose to win. So that's what
if you will, Edward, I want to comment on that, because you touched on something that's pretty important. And I think it's important to understand for everyone on the call when it comes to bonding. And I think what Edward's talking about is, to pay a CPA, a construction CPA, a construction bookkeeper, construction, what have you, it does cost a lot of money to get it set up. But once it's set up, it should run like an engine, right? You put gas in it, a little bit of money in it. But the one part that's really important is a lot of people worry about how much their bond rate is. And I understand that as it relates to their bottom line bid on a process, on a project. But everyone that provides a bid bond to a general contractor, that bond should be paid for, and it should be a line item in your bid that says bond cost. It's rare that you should ever have to pay for a bond completely straight out of pocket, unless you just missed that line item. And I will also say that for your insurance should be a line item, and you should have some sort of a calculation that you can put your payroll or your subcontract costs against your current rates to be able to understand what the cost is in insurance for the project that you're bidding. And that insurance should get paid. Your whole insurance premium throughout the year should almost get paid for from construction projects that you're bidding. Now, if you're a contractor that's not putting insurance costs in your bid, then if you're bidding and let's say your profit margin is 10%, it's really not 10%, right? And from the eyes of the surety, one of the worst things you could do, and this is another note, Kyle, close your ears. But what I have my guys do is give conservative numbers. Don't say, when you fill out a bid bond request form that you're going to make 25%, even if you know you are, so you're going to make 20%. Give yourself a buffer room, because one of the things that comes out is when they're looking at that work in progress and you're not hitting your numbers, regardless of the reason, it's always easier to explain that you made more money than it is to explain a profit fade on a job. Just keep that in mind. Your insurance should be a line item. You should be able to calculate rates on your current policy to insert them into your bid to make sure that project is going to pay for your insurance. It should not come out of profit. All right, we're going to continue on. Next question.
Well said, Don. All right, so case percentages. So this is something that Don and I talked about, wanted to include, which it kind of breaks down like, what's your working capital get you as far as surety credit. So one of the primary ratios that someone like me would look at on determining how much surety credit to extend is a working capital case percentage. So first, let's look at working capital. That's what we talked about before, is current assets minus current liabilities. And to get to that working capital case percentage, it's working capital divided by the amount your program. So program as in how much backlog you're running or you want to run. And so typically most surety companies look for is a 10% case, 10% working capital case. That just means you have, your working capital is 10% of the program that you're seeking to construct, to run your backlog. So let's just, a few examples we can go down. Look at, a 10% case. If you have $100,000, a 10% case would be $1 million in surety credit. If you have $250,000 in working capital, that would typically afford you $2.5 million in surety credit. Then 500,000 would be 5 million. And so, these are just examples of target working capital figures that an underwriter would be looking for. And it's by no means like a hard number. There's every contractor is different. We look at, the merits of each one as, what they bring to the table. No one's cookie cutters out there. And so, there's, it's just a good, target to be looking at. And in the back of your mind of, if you want to be doing 5 million in backlog, running a $5 million program, it's typically you'd be shooting for about $500,000 in working capital.
And from here, I want to take you guys, just run a couple quick scenarios, because I always talk about the end of the year. You got to pay taxes. It's just, that's the nature of the beast. So if you look at the first 10% case of 100,000 in working capital, let's say we're getting to the end of the year, you got this stockpile of cash you need to do something with. Let's say you use 50 grand to go purchase some autos or go purchase something or just do a distribution. Well, you see where that working capital was 100. If you decrease that to 50K, that's decreasing your bond to 50K. And the cases go on. It has the potential to. Now, if you have financials that have enough girth in them to withstand the distributions you're taking, it's fine. But it's a good time to meet with your CPA and your surety and tell them what you're thinking about doing so they can tell you how that's going to affect bonding. Once it's already done, and then you come to the agent or the surety and says, well, yeah, I took 100 grand out for I wanted to buy a house in the Caymans. Well, that potentially could destroy a whole bonding program. And it's happened to me on a couple of occasions to where the client took out distributions at the end of the year, didn't talk to me, didn't mention it. They want to get a bond, they send in the financial statements, and the surety underwriter notices a big distribution that's been taken out of the company that hurt the company in a bonding capacity standpoint.
Sure. It could even be like, less extreme. It could be like, you have 100,000 in working capital and you want to buy this excavator, right? And you're thinking, well, this excavator is going to be, on the balance sheet. It's going to be accounted for as equity. So, it looks like an appealing deal versus renting prices is, maybe you pencil it out for the year. Doesn't make sense to rent, but, I got a good deal on this purchase, so I'm just going to buy this. Well, you got to think about it that, 100K that you use to buy this asset that's going to perform for you, just depleted your entire working capital. So you got to, start weighing in on when does it make sense to purchase that piece of iron or that new truck or the tools, and still maintain an adequate line of surety credit. And so, there's always that balance. And I'll say about that 10% case too, like the bigger the number you get, like when your balance sheet starts to get larger and larger, there's a more flexibility. You can leverage that balance sheet a little bit more to get more surety capacity. But I'd say always 10% is a good target to be aiming for.
Oh, there.
Don has technology issues today.
Wow.
All right.
You got to get the Beats by Dre, Don.
Yeah.
Right.
Oh, all right. So internal system. This is another thing that's another aspect of a contractor that I look at when reviewing any of my contractors I work with is like, does the contractor have the ability to produce internal, accurate, and timely statements? So that's on their work in progress. I want to see that my contractor that I'm bonding is producing a WIP, a work in progress statement, so that they're updating it, that they're updating the budgeted costs, and so I know that they're, feeding their system with accurate information so that they know where they're at. That's a scary thing, is to, be running, for months and months and not really know how much money, or if you're making money at all on a certain project. So when you're tracking, with accurate financials, that's always a positive, and will always play well into, if you're pressing for additional surety credit and maybe the balance sheet doesn't really support it, but I know that, hey, your statements are accurate, what I have is accurate, and that's another variable that can get you additional surety credit. And on the WIP, that's the contract price, the estimated total cost, the cost to date, the bill to date, the cost to complete. Those are the columns that I'm looking at. And like I said before, the WIP is kind of that look ahead. It allows me to see, how much profit's left in the job, how much revenue is there, and so especially rolling into the next year, if you have a good revenue base, that backlog is going to generate a large amount of revenue that may take a big chunk out of overhead, to where, I could say, oh, well, yeah, they only need a couple more projects, let's say $1 million more, and they're going to break even. Yeah, they're going to have a great year next year. So it's that the internal systems is definitely one of the variables that and attributes of a contractor that I take pretty serious when I'm reviewing.
And if you're running a company, no matter how big or how small, typically I see this with contractors that are trying to grow. You know, I equate the internal systems to the foundation of a building. If you don't have internal systems, just like if you don't have a foundation, if you build a skyscraper on the dirt, that first rain that comes, you're going to start having problems. It's the same way with your internal systems of a company. You want to be able to track costs. This is an area that I see the most inadequacies in, because oftentimes I'll get a work in progress schedule 1 month, 3 months later, I get it again, and it's the same thing. They haven't even looked at it to make sure that all the data points are making sense. So internal system is the foundation to your company, and everyone should have good internal systems.
Yeah. I mean, to the best that you can, you know, like Don said, just if you have the same numbers month in, month out, you know, how do you know if you're making money, or if a big, you know, spike in costs, you know, hit on a certain job and you don't know about it and you haven't been updating the numbers, like how do you adapt? Like the sooner you can recognize that, whoa, hey, this isn't going according to plan, to my budget, and then maybe you can identify what the problem is and, you know, throw some extra manpower at it to right the ship.
Or ask for a change order.
Yeah.
If you're talking like that, that means something was added to the job, in my opinion.
Edward, you'd be surprised, man.
But you know, when you're surprising me about money, surprise change.
But this surprise only comes with contractors' knowledge and understanding their financial statements and what they're turning into the surety. I know that it takes time to get used to a work in progress schedule that aligns with the financial statements, because you also have, and we won't go into it here, but you also have the over and under billings that factors in to where one's an asset and one's a liability. So understanding your work in progress schedules, if you're not using anything on the job to track whether a job is profitable, your work in progress schedule can tell you that little bitty leak hole has now opened all the way up, or it's closed completely. Go ahead, Edward.
Yeah, so when you're talking about work in progress statement, because this didn't go exactly how it went with mine, and I've only had one, so it's not like I have major experience, but it was a great experience. But the only thing I really had to keep track of, so when I think of you saying this, would be my certified payroll. Is that what we're discussing here, or is there something more?
Well, there could be something more. In your case, most of your projects are tied to man hours on the job, right?
Yeah.
Yeah, so you're tracking, you know, and more complex construction, there's a lot of other moving parts that affects it, right? So, and typically the work in progress schedule, depending on what the bond program is, it's going to be, we're not going to put all, you know, if you have 10 jobs that are all under 10K, we're not even adding those to there. We'll group all those together, but there it won't be in the specific formula of the work in progress. So you're really just talking about tracking some of the bigger jobs that you're on. But oftentimes, people lose track of man hours. They may have bid that job at 100 hours, and we're halfway through the job, and we're seeing that the hour is already at 85 hours. Well, you know, halfway, 50% complete in your job, man hours allowed for that project are already at 85%. You have 15% left as far as man hours when you have 50% left of the project. That says there's a problem somewhere.
Yeah, and real quick, Don, I still remember the first training that Kiewit offered, and I think it was Kent who said that even the big firms struggle sometimes with this, because you might think because of your past project, the production rates were this and the labor hours were that, and you might, you know, somewhat, you know, kind of have that consistent pattern of saying, okay, here's what my conservative number is, and you don't know if you're over or under. And I think it's just so paramount, especially for a small business, if we hear from big business, that sometimes you can lose or gain money depending on how you really play that game of, like you said, on that work in progress. Are you billing properly every month? Are you keeping money that you haven't billed on kind of somewhere in the shoebox? Like, I mean, this internal systems thing, I can't even say it enough. It's probably the way that most businesses lose money that are small. You can tell me if I'm wrong, but I've seen it enough to where people don't even know where the numbers are, like Kyle just mentioned. Like, just kind of shooting in the dark and I'll make it up, but like, make it up means you're probably losing money too.
Yeah, and it also goes and ties into when a company is on that growth path and they got into a certain point to where they changed their accounting system to a percentage of completion. That's a whole nother world, but it's tied because that percentage of completion is tied to how they pay taxes on open projects or closed projects or projects just started. So there's a lot to it, but as I said, if you just keep in mind, building, foundation, concrete, or dirt. This is the cement. If you don't have any of these, you're building on dirt. Go ahead, Edward.
Yeah. So are you talking, when you say internal systems, are you talking just like software?
Software, QuickBooks, oftentimes, yeah.
I have software. I was just wondering if I'm missing something.
Yeah. Well, oftentimes what we also see is, a lot of people, they would have already spreadsheeted out how they track their jobs. That's okay, just as long as you're tracking them some kind of way and you have an internal system is what we want. Because oftentimes, especially when I was newer, you'd be surprised at how many people were literally operating out of a shoebox. And being that all of their stuff was just in one big pile, they didn't know anything on there. It happens. It's understandable, and there's ways out of it. I've gotten companies out of the shoebox, set up with internal systems, and they're still good today.
And that's massive, that shoebox thing, because I talk to a lot of guys about software, lots and thousands weekly.
Yes,
literally.
and very important. It don't matter what you use, just as long as you're using something.
Right, I agree.
And that takes us to the next slide. When you are talking and you're going to submit, or you're going to give your information to an agent to submit to a surety, this is a complete checklist of what I'm going to be asking for, what the surety wants to see. I do understand that not everyone's going to have everything on here, but, completed contractor's questionnaire, pretty simple. Financial statements for 3 years. They want to trend it out to see what your past experience and profitability has been. Personal financial statements. This is an area that's kind of funny because when the surety is asking for a personal financial statement, it's the time to shine. But oftentimes, business owners water down their personal financial systems because they don't want to show too much. Well, it's kind of like, the surety wants to see all of the success that you've had in your company and that you've been able to pay yourself and accumulate wealth. So they want to see everything on your personal financial statement because it shows how successful you've been at business sometimes. They want to see copies of business, personal bank statements, resumes of principals and key personnel. They want to see the company articles of operations and agreement. They want to see a copy of the bank loan agreement. In some cases, the company will also want to understand what your succession plan is. If a surety company is going to grant you 10 or 15 million in surety bonds, they want to know that you have a plan. If God forbids, if it's your time and you get called to go to heaven, they want to know that you have a plan in place where you have someone in line, maybe a key personnel or one of the principals that's going to step in for you and get these bonded jobs completed, because that liability doesn't go away just because you do to the company. Is that correct, Kyle? Just
Yeah.
take the nod.
I'll try to hit on mute. Yeah, Don, absolutely. Yeah, succession planning, continuity. You'd be surprised. I received a submission not too long ago, had an 85-year-old principal wanting to bid, $5 million job, already had 10 on the books, and sole owner. And, that's a hard sell. There's no continuity planning, no succession, not even a key man agreement to agreeing to complete the work if he passed. Yeah, it's good to see. It's good. Young contractors, I think that's something that I'm not going to be pressing on too much, but when you start to have large backlogs and you're the sole owner, the rainmaker, and you're also boots in the ground and inside, like the operation wouldn't be able to operate without you. Yeah, succession planning, I'd like to have some sort of dialogue about that. But yeah, then when in aging contractors, I'd like to see, have you identified somebody new that's, you're going to start grooming for ownership? And just like Don said, you want to make sure that, if anything happens, that someone's there to complete the work.
Yeah, in another area, I'll just mention it real quick. Oh, go ahead, Nick.
It's kind of related, but somewhat unrelated is, NAMC also has architecture and engineering firms. And so I'm wondering, is there different insurance requirements, or how do A&E firms play into bonding, if that's even a consideration? And I'm not sure. I know that that's a different line of business, but I wonder, do they have some of these same hurdles in a different insurance realm?
They do, because their world is so completely different. I think in my 21 years of insurance, I got my first A&E bond this week, which was part of a requirement because of the job and the scope of the job. Out in the wilderness, the surety wanted the A&E firm to bond back their portion, because if there was somewhere that was going to go wrong, it was going to be in the design portion of that project. And it's a little bit more cumbersome, I think, for an A&E firm, because typically they don't bond. And it's a completely different mindset for a firm that knows they have bonding versus a firm that knows they won't have to post a bond. At the end of the year, they can do different things than someone bonding versus not bonding. It's a different world out there for them.
Yeah, Don, this is John Jackley. Sorry about the video thing. Hey, I had a question. Don't A&E firms, I know that with mine, you typically have professional liability, and then you might have to do a project completion bond, or even in some cases, a mobilization cash advance guarantee. I mean, they're different products, right? It's separate from a construction contractor.
Correct. They are different different products. For an A&E firm, the biggest portion of their insurance is going to be the professional liability.
You bet.
Because the general liability is excluded on an A&E firm, and it's primarily for trip and fall, right?
Yeah.
But all of your exposures is in your professional advice.
Mm-hmm.
So yeah, it does get into different type of bonds also. That's different than the just typical payment and performance bonds, John. Yes.
Yeah, right. There's today we're talking about contract bonds, so that's just construction, performance, payment. There's a couple other contract related bonds, but then there's commercial bonds. Pretty much any obligation can be bonded. Like any obligation, you can make up an obligation and make a bond for it. So that's a whole different set of underwriters. So for me, I just do contract. I work with contractors exclusively. But there's the commercial side that, the sky's the limit. There's like new obligations made up every year that they have to underwrite and look at.
Yeah, and I just wanted to pose that question because there will come a time, probably in the new year, Don, where we want to start zeroing in on the A&E side, because we do have a growing populace of A&E firms that are signing up with NAMC, and Clarence being one on here today, obviously John, and I think Vinky just signed in. So certainly some firms that maybe they got it already figured out, but certainly want to just make sure we capture some of that. So maybe that's another training for another day.
Absolutely. I did want to mention one more thing here, y'all, because I haven't mentioned it. And it's something else that's really important, for all of the construction owners that are married and have families, right? It's also important for these owners to take a look at key man life insurance for them, because if something happens to that owner that's working in the business every day, do you want to put it in a position to where your wife is going to come in to run the company because she has to, because she still has a family to take care of? So you guys should also look at key man life insurance policies as well on the owner and key staff. It's a cost that's associated with it, but it's also a safety stop in case either you lose a principal or a key personnel, it gives you that ability to go and hire that person right away.
As a contractor sub, is Edward, I second that. I have that lined up too, Don. Just to reinforce what
Don,
you
was
said.
it?
You suck at what, Edward?
Life insurance?
I said I second what you're saying because I have that just in case anything happens to me. So not obviously, but I reinforce what you're saying as one of the guys listening in today and as a NAMC member, it is important that you make sure you're thinking that forward thinking like that because anything can happen at any time. So I second that notion.
Yeah, and it really, you don't want your wife to have to come in. If the owner passes away and there's a key man life insurance policy in place for that owner, they can go and hire another CFO rather than having to have someone come in with no experience to run the company, or if you lose a key personnel. David, you had a question?
Yeah, did you mention a certain name, Keyman Life Insurance? Was that what you said?
It's called Key Man Life Insurance. It's just a life insurance policy you put on place on your key employees. You have to get their sign off and they have to be okay, because if the company is paying the premium for it, then they're also going to be the beneficiary if something happens to that person. So they have to sign off that they are aware that there's.
Don, I'd like to ask you a question.
I think he has a question, Don.
Don, my company does a temporary labor staffing for technology projects in software programming, databases, networking, and those areas. My employees, they're on site at the client site, be a part of the team and work on a project. So in that case, clients ask me to have the errors and omissions and the professional liability. Usually in most of my cases, we are part of a team. We are not the one person who goes and makes a major change to a system. Because sometimes my professional liability and errors and omission cost me like $3,000 or $5,000 a year. Is there anything, do we need to be aware and do we need to be concerned when I sign those big contracts with errors and omissions for $2 million or $3 million?
Can you tell me your question again, Vinny?
My question is, how would I protect myself? Because I have a contract with City of Portland. So they asked me to have $3 million in errors and omissions. I have it. My employee making that mistake is very limited. The reason is he is a part of a big team of 10, 20 people. He adds a small portion of the project, writing some programs, writing some reports or something. Does not affect the whole system, but still City asked me to have a $3 million errors and omissions. Do you have any choice, or even though my project may be $100,000 value project, but still I need to carry a $3 million? I was just wondering, how do I negotiate with my customer? Is there anything, you have any ideas?
Vicky, that's a tough one, because I know that when you're looking at bidding a project, you're going to give them a certificate that shows your current limits of insurance against what's being asked for in this bid. And I think we talked before, what I do, I don't know if it's possible or not, because I know sometimes you're bidding a project and they want you to have $5 million of professional liability, coverage. You only have 3. You don't know if you're going to get the job, and you don't want to go out and spend the money to increase your limits by $2 million, and you may not even get the job. So how do you go against that? I mean, how do you bid in that world to where you know that there's a potential? And typically what our clients do is they have a quote, so you know what that number is to increase your policy to the 5 million from the 2 million, and we know what the cost is, and it's just, can you write a red line or, work with the purchasing officer to say, hey, if I'm awarded this project, I will provide a certificate to you at the limits requested, but as a small firm, I can't afford to just go and carry 5 million in limits if I don't need to carry 5 million in limits. And that's a hard one. I know on the construction side, I have seen in the bid docs where, maybe they want pollution coverage and railroad coverage. and you have to give them the certificate of insurance to bid, but typically they will accept it. And if you are awarded, then you have to adhere to the insurance requirements within that document or within those bid docs. So it's a tough question to answer, Vicki.
I know. Thank you, sir. I appreciate that.
You're welcome.
So Don, real quick, John Cardenas asked a good question too. He said, how can large GCs temporarily share their bonding ability with a smaller sub? Is that even a thing? And I know there's multiple ways you can skin that cat, but I mean, certainly one that feels appropriate. I've seen from my city days, large GCs do some of that before, but I guess what would your recommendations be on that question?
Typically, and they don't do that. That's my
Well, yeah, typically there are programs where, you know, it's rare that you're going to get a general contractor to vouch in form of an indemnity for a smaller contractor so they can participate on their programs. You know, we have brought some ideas to the municipalities here in Portland before the COVID that I know the Port of Portland, Metro, City of Portland, they were all looking at that would lend that exactly where you're saying, that support for a contractor that maybe didn't have the capacity, could perform the work, but just needed a means and a way to get the bond. You know, I think in the environment that we have today in construction, more of these type of solutions need to be formed because you have a lot of BIPOC contractors that can perform the work. They just can't get to the bonding levels that's required. And it's like, you know, can I just get a chance somewhere, you know, to get started? There are other bond programs out there as well for some of the big GCs that, you know, they carry. But it's like Safeguard is one where GC can carry, and it's for subcontractor default. But that's a hefty, it comes with a big price tag to the general contractor to have a program like that in place. So it's tough. I've rarely seen it done at that capacity for a GC to share the limits with a sub, unless it's a critical sub, specialized sub, then they may offer, but it rarely happens.
Yeah, and I mean, Don, I remember that. I mean, obviously we didn't have a lot of our agency partners in those key meetings that you helped set up with some of the national groups, but John is with Prosper Portland is on the call, and he certainly wants to figure out how Prosper can embrace this and put some of their money where their mouth is, because this is too big, as you already know, for it to just be a port thing. I know we've talked to Metro and the City of Portland and ODOT, and, you know, it seems like a group plan or something that they can actually, you know, support needs to happen. And so he just wanted to make sure he could chime in to see what he needs to do next to maybe push that forward in 2021.
John, just give me a contact and I can set up a call, because we had a group call with the company when we were talking to all the municipalities, and it's kind of gone on the wayside since COVID has happened. But, you know, I think it's ever more important right now to have that program, especially with all of the perceived money that's going to be hitting the streets in form of projects being released. We do need another avenue, and I can pick that conversation back up as well. But if there's one thing that I want to leave everyone with today, that's small business, or not just business in general, is this. The one thing you can do, whether you're financially able or not, you can start working on this process is clear your credit reports up. You know, get any collections, any tax liens, get that out of there. If you have a collection or a lien on your credit report, you can already close the book on any decision on bonding, because it's not going to happen. And that's one of the easiest things there for you to do is clean up your credit report, start working on it, download Credit Karma, one of the free apps, so that you can monitor. They give you all the contact of all the creditors on your credit report. Try to work out a deal with them. Look at your company's credit report. Make sure that you have all that up to date. I know a lot of people don't like.
I do it every day, Don.
What's the program, Cal, that I'm trying to?
You're talking about the one from New York. The brothers' names. I know what you're talking about.
Yeah, I'm just.
Polish and Associates or something like that. I know who you're talking about.
Dun and
Bradstreet, yes.
Yeah,
Go and create an account for the Dun & Bradstreet, type in your company and see what shows up. If it's negative, start working right now to get that removed. And it kind of sucks because they put misleading or false information on your Dun & Bradstreet, and you got to pay to get it off.
That's right.
But be diligent about that, because even though I don't like it, you may not like it. As of today, financial institutions, lending institutions are still looking at the Dun & Bradstreet, and that's like the Credit Karma, the TransUnion for your business. They're looking at how you pay your suppliers. And if there's a bad rating, your company has a bad rating there, that could be a reason why you can't get over the hump. Or it may be a reason you can get over the hump because you say, look, I paid my people. I'm paying off all my bills. I pay on time. My Dun & Bradstreet looks good. It's not the sole decision, but it factors into making those kind of decisions. Any closing words for you, Kyle?
Sorry, I'm having a difficult time tracking down that unmute button. No, I think that's a great summary, Don. I'm just happy to be involved and hope that you derive some value from this. If you have any questions about it, reach out to Don, and I could circle back with him and help out if there's any specific questions. So I really appreciate the opportunity to share.
Yeah, and I want to thank all you guys. Oh, sorry. Go ahead first, Edward, before I close this out.
Being recorded.
Yes.
Okay, cool. Because Don, it's your lucky day, bro. I'm gonna send that to Credit Karma. I'll give you the shout out.
There you go.
Edward's always on top of it. I want to thank personally you, Don, for sure, for all your time and commitment. Certainly Kyle for tuning in today. And as much as you want to come back, Kyle, and tag team with Don, you're always welcome. And then always, I want to thank the members, whether you know this stuff or not. I mean, it's always a good refresher. It's also very rewarding for other members who may or may not be tuning in because of the fear factor and not really knowing this stuff. Because trust me when I say we know some of the people who didn't show up today were very nervous and they want to see the recording after the fact. But we want to make sure that they get in the room and speak truth to power like Edward and David and Vinky and Clarence and everybody else who tuned in. Because if you don't know what you don't know, it will hurt you at the end of the day. And if you can actually bring what you don't know here, maybe you'll actually gain a little and build a little bit more with progress towards building a better company. So I want to just continue to thank you guys, because a lot of people, I hope they don't get left behind, but if they don't take this stuff serious on what we talked about today and all the other trainings, I hope that they'll figure it out one day. But as you guys continue to do what you're doing, all of that's going to come out. So I appreciate it, John. Please do follow up John Cardenas with Don, and just want to make sure we can advance that from the agency side. Don, you want to close us out?
Appreciate it.
Yeah, and you guys, with this presentation, there's 2 handouts that I gave to Nate to send out. You guys should take read that information. It's some good information. It's industry whole put out. It's some really good information in there. And always remember that, the dumbest questions is the questions not asked.
That's right.
Yep. And share it with your peers, Edward. Everybody who, may not know none of this, give it to them. We're here. So Don's available, but I want to thank y'all and let y'all have the rest of your time back. NAMC committee with Kent and everybody else on the call, Kanan included. Thank you. And we'll see you soon. And we'll see you on November 4th for our next general meeting. And for anybody who's interested in the Procore training, we got a free training tomorrow around some great programming that we're going to get some subscriptions for NAMC members to have project management software. So just want to make sure people know our national office is trying to get us a 75% discount on a program that a lot more GCs are starting to use. I'm sure Kent and them know about these programs as well, but big time. So let's just all stay together and we'll all be better for it. So thank you.
Thanks, Nate. Thanks, Don. And thanks.
Appreciate it. Yeah.
Don, I like your last slide. It says if you have the good surety bond, you can go and play golf with a smiling face. That's a good one.
Or play the guitar, perhaps.
You guys get.
Bye-bye, y'all.
Thanks, everybody.